Welcome to Enviews.ai, your AI-powered investment insights hub. Key takeaways. Small and mid-cap stocks have outperformed large caps in 4 of 5 recent Fed rate cut cycles, both on absolute and risk-adjusted basis. Lower interest rates disproportionately benefit smaller companies due to their reliance on debt and sensitivity to economic conditions. Current market indicators suggest potential for small and mid-cap surge, including favorable valuations and expected rate cuts. While offering higher potential returns, small and mid-caps carry increased risks such as volatility and liquidity concerns. Investors should consider sector-specific approaches, quality metrics, and long-term horizons when investing in small and mid-caps. Introduction: the shifting paradigm in equity markets. As the global economic landscape evolves in response to macroeconomic shifts, a notable transformation is occurring within the equity markets. Small capitalization, small cap, and mid-capitalization, mid-cap, stocks, historically overshadowed by their larger counterparts, are experiencing a renaissance that demands the attention of both institutional and retail investors. This resurgence is not merely a transient market anomaly, but a phenomenon deeply rooted in historical market behavior and economic theory. However, by just observing small, medium, and large cap stock indices levels, their relative performance is not obvious. As we will examine in the following sections, small and mid-cap stocks have historically outperformed their large cap counterparts. During the last 4 out of 5 Fed rate cut cycles, small and medium cap stocks have outperformed large cap stocks on both absolute and risk-adjusted basis. The potential for interest rate reductions by the Federal Reserve serves as a catalyst for this market shift, prompting an adjustment in asset allocation. This analysis aims to elucidate the intricate relationship between monetary policy, specifically interest rate adjustments, and the performance of small cap and mid-cap stocks. By examining historical precedents, economic fundamentals, and current market conditions, we seek to provide a nuanced understanding of the opportunities and risks presented by this evolving market dynamic. The nexus between interest rates and small cap/mid-cap performance. Historical and economic context behind the surge. The relationship between interest rates and the performance of small cap and mid-cap stocks is grounded in both empirical evidence and economic theory. Historically, both the Russell 2000, a benchmark for small cap stocks, and the S&P Mid-Cap 400 have demonstrated a consistent pattern of outperformance following periods of interest rate reductions by the Federal Reserve. This phenomenon can be attributed to several interconnected economic factors. Cost of capital. Small and mid-sized companies often rely more heavily on debt financing compared to their larger counterparts. As interest rates decline, their cost of borrowing decreases, potentially leading to improved cash flows and enhanced profitability. Growth prospects. Lower interest rates typically stimulate economic activity, benefiting smaller companies that are often more sensitive to domestic economic conditions. Valuation metrics. In a low interest rate environment, the present value of future cash flows increases, potentially leading to higher valuations for growth-oriented small and mid-cap stocks. Risk appetite. Reduced interest rates often correlate with increased investor risk appetite, benefiting smaller, potentially more volatile stocks. Quantitative analysis of historical performance. To substantiate these theoretical underpinnings, let us examine the historical relative performance of small, mid, and large cap indices during periods of monetary easing. Looking back at previous cycles of monetary easing, a clear pattern emerges. During the challenging economic period from 1979 to 1983, the Russell 2000 index outpaced the S&P 500 by a staggering 80%. Similarly, from 1990 to 1994 and again from 1999 to 2014, small caps consistently delivered superior returns compared to their large cap counterparts. Our analysis reveals that in the 6 months following the initiation of rate-cutting cycles over the past 3 decades, the Russell 2000 has outperformed the S&P 500 by an average of 5.3 percentage points, while the S&P Mid-Cap 400 has outperformed by 4.1 percentage points. Current market landscape. Indicators of a potential surge. As of July 26, 2024, with the Fed signaling potential rate cuts, small-cap stocks are once again in the spotlight. The Russell 2000 has surged approximately 9% over a recent 5-day trading period, a stark contrast to its relatively flat performance earlier in the year. This movement suggests that investors are already positioning themselves for a potential small-cap rally. As of July 26, 2024, several key indicators suggest that small-cap and mid-cap stocks may be poised for significant growth. Valuation disparities. The forward price-to-earnings (PE) ratio of the Russell 2000 relative to the S&P 500 is currently at its lowest level in over a decade, indicating potential undervaluation. Economic recovery indicators. Leading economic indicators suggest a broader economic recovery, which historically benefits small and mid-sized companies disproportionately. Sector composition. The higher concentration of cyclical sectors within small-cap and mid-cap indices positions them favorably for an economic upturn. Monetary policy expectations. Market expectations of forthcoming interest rate cuts, as indicated by federal funds futures contracts, align with historical conditions favorable to small-cap and mid-cap outperformance. Investor sentiment and market dynamics. The shift towards small caps represents more than just a reaction to interest rate expectations. It signifies a broader change in investor sentiment. After a prolonged period of large cap dominance, particularly in the technology sector, investors appear to be diversifying their portfolios and seeking value in previously overlooked market segments. Challenges and risk factors. While the outlook for small-cap and mid-cap stocks appears promising, a balanced analysis must consider potential challenges. Volatility. Smaller companies inherently carry higher volatility, which may deter risk-averse investors. Liquidity concerns. Reduced liquidity in small-cap stocks can lead to higher bid-ask spreads and increased trading costs. Economic sensitivity. The same factors that drive outperformance during economic expansions can lead to underperformance during contractions. Valuation risks. Rapid price appreciation may lead to overvaluation, increasing the risk of corrections. Investment implications and strategies. For investors seeking to capitalize on the potential outperformance of small-cap and mid-cap stocks, several strategies warrant consideration. Sector-specific approach. Focus on sectors poised to benefit most from lower interest rates and economic recovery. Quality metrics. Prioritize companies with strong balance sheets and sustainable competitive advantages. Diversification. Employ a basket approach to mitigate company-specific risks inherent in smaller stocks. Long-term perspective. Given the higher volatility of these segments, adopt a longer investment horizon to smooth out short-term fluctuations. Conclusion: navigating the changing tides. The potential resurgence of small-cap and mid-cap stocks in a changing interest rate environment presents a compelling opportunity for discerning investors. While historical patterns and economic theory suggest the possibility of significant outperformance, it is crucial to approach this opportunity with a nuanced understanding of the associated risks and challenges. As the market landscape evolves, successful navigation will require a combination of rigorous analysis, strategic allocation, and ongoing vigilance. By understanding the complex interplay between monetary policy, economic cycles, and market dynamics, investors can position themselves to potentially capture the upside of this market shift while managing downside risks effectively. Thank you for watching Enthusiast.ai, your AI-powered investment insights hub. Please subscribe for more timely investment insights. By viewing this video, you agree to the terms of the disclaimer provided in the description of this video in the channel or page description.